Hi everyone, my name is Asher George and thanks for tuning into J2 Wealth. Let's get started with this week's world market news. Inflation in the US as measured by the Consumer Price Index (CPI) declined to 2.9% on a yearly basis in July when compared to 3% in June. The annual core CPI, which excludes volatile food and energy prices, rose by 3.2% following a 3.3% increase in July. This is in line with analyst estimates and could trigger a 50 basis point Fed rate cut in September. Japanese yen remains stronger due to the hawkish mood surrounding the Bank of Japan. Due to political uncertainty, the yen may face some uncertainties. Gold has corrected from a chart resistance of $2,470 after strong US retail sales data. The lower US jobless claims data has also brought about a positive impact on the US economy, erasing recession fears. The precious metal is probably unfolding a leg down within a sideways market. UK inflation rises 2.2%, which is less than expected in July. The British price consumer inflation rose for the first time this year in July. A big economic blow for Xi Jinping of China as investors pull out over $15 billion. After decades of high growth, China became the fastest growing economy and the second largest economy after US. But it seems the success story is coming to an end, at least for the time being. After registering a negative foreign direct investment last year, investors pull out a record $15 billion out of the country. Moving in to Indian markets. India's retail inflation eases to 3.54% in July, which is the lowest in the last 5 years. Its industrial production increases to 5.2% from April to June, which is a 0.5% increase on year-on-year growth. India's defense exports skyrocketed by 78% in the first quarter of 2024-25, setting a new benchmark. Odisha is poised to recover over 1 lakh crores in pending dues as several states are to receive financial benefits as the Supreme Court's decision to allow retrospective collection of taxes on mineral-bearing lands from April 1, 2005. Metals and mining stocks fall about 5% as Supreme Court allows states to collect past tax. Stocks like Tata Steel, NMDC, Vedanta hit. Direct tax collections surges 22.5%. The total net direct tax collections, including personal income tax, rose to 4.47 lakh crores and corporate tax collections at 2.22 lakh crores. After 4 years of high double-digit growths in profits, corporate earnings of Indian companies hit a speed bump in the first quarter of FY25. This leads to the downward revision in estimates and an increase in volatility in the equity segment. Effective January 1st, 2025, the RBI set a few guidelines on the acceptance of public deposits, the maintenance of a minimum percentage of liquid assets, the full cover of a public deposit, and the repayment of a public deposit in the event of an emergent nature to cover certain expenses. These guidelines would be applicable on non-banking financial companies and housing finance companies. Moving in to stocks in news. SBI hikes lending rates for the third time in a row. Consumer loans to get costlier effective August 15th. The benchmark 1-year MCLR, which influences most consumer loans like auto and personal loans, has increased from 8.85% to 8.95%. Hindustan Zinc plunges 10% on Vedanta's 3.17% stake sale via offer for sale. REC incorporates Rajasthan Power Transmission Project as its new wholly owned subsidiary. SBI aims to sell its stake in Yes Bank of 18,420 crores by the end of March. Reliance Retail gets 14,839 crores worth of debt from its parent company for strategic growth. Torrent Pharma seeks to raise $3 billion for KKR's stake in JB Chemicals. Bharti Global to acquire 24.5% stake in UK's BT Group. Cochin Shipyard commenced commercial operations at its international ship repair facility in Kerala. Muthoot Microfinance in talks with European investors to raise $50 million. LIC to invest rupees 1.3 trillion rupees in the stock market. Both MD and CEO signed off. Thanks for tuning in. For more finance and market related updates, please make sure to like, share and subscribe to our channel.